Sure. So yeah, and thanks again for having me on, and thanks everyone for being here. My name is Rob Beardsley. I'm the founder of Lone Star Capital. We're just over a 3-year-old owner operator of Texas workforce housing with a particular focus on Houston. We we own and manage over 1,000 units in Texas, and in total, our partners on 100 million AUM. Our particular focus, like I mentioned, is workforce housing. So we target kind of the C minus to the B minus space, and we look to lease up, value add, reposition assets to, maybe half a score above, B minus to B or C plus to B minus. So we like to find deals that are underperforming from an occupancy standpoint or rent standpoint, have deferred maintenance. We like to buy from long-term ownership and maybe partnership issues. The hairier the better, as long as we're being paid for the risk. So that's a little bit about us. I can't say what I have tonight is a presentation. I'm a pretty lazy guy, so typically on these I just share you my spreadsheet, share you my screen, and we just have a good conversation and throw any question at me, and I just need to find the chat box and we can dive in. But the topic tonight is stress testing, which I think is always a fun one and can help you look beyond just the numbers. I don't know about you guys, but I know for us, and I don't think this is a mistake necessarily, but we are so fixated on IRR. We look at deals all day long. We're always saying, okay, well, at this price, what IRR? And then, is it the gross IRR? Is it the net to investor IRR? And if we tweak this, can we do this? And so we're so focused on IRR, which I think is fine because that's our bogey. That's our discount rate. We determine what price we pay based on that number primarily. And there's obviously a lot more that goes into that and supports that number. And I think stress tests are one of those things, because sometimes you can look at a deal and the number or numbers look good, but then if you look through and take a deeper look, whether it's by analyzing the inputs themselves or by stress testing, you can uncover that maybe, on the surface it looks good, but digging deeper, not so good. So, and also I see some familiar faces on here. Looks like we've got maybe some more experienced people on the call and whatnot. So I definitely don't want to just, parrot my normal pitch and, the basic stuff. So if there's a desire to go more advanced or to go deeper, I invite you to do so. So to start, I'm going to jump over. So first, let me introduce what we're looking at. This is my underwriting model that I built from scratch and that we use every day to underwrite, 1,000 deals a year. If you want to follow along, I don't know if this exact model is available, but if you go to our website, which is lscre.com, you can get this downloaded for free, and then you can kind of follow along or, break this thing, make it your own, edit it. You'll see the locks at the bottom, but there's no password. So if you want to unlock, you just hit the review and hit unprotect, and then go for it. Look at the formulas, change them, all that good stuff. So first off, this is just a hypothetical deal. I threw some numbers together. Here we have a pretty attractive looking deal at 21% project IRR. The cash flows are good. We've got a 3-year hold here, which is maybe a bit different than the traditional 5-year hold. And I think that's because this is a bridge loan deal. Let me just see. Yeah, so here we're using bridge financing, more expensive on the rate. Today, maybe it's a little cheaper. Full term IO, 80% loan to cost. So this is modeling a bridge loan. That's why we do a 3-year hold on a bridge loan. It's that awkward thing. We're seeing a lot more interest in bridge loans. And I don't know what you guys have seen or think about bridge loans. I know that back in 2018, when interest rates were rising and a recession was on everyone's mind, everyone thought a bridge loan was the worst decision of your life, super risky. Your loan's going to mature right in the middle of a recession and you're toast. Oh, and by the way, bridge loans are typically floating rate debt. And so we all know interest rates are rising. This is, again, back in 2018. So you're going to continue to pay higher interest costs. And the yield curve inverted. And so the floating rate debt was more expensive than fixed rate debt, which typically you have cheaper floating rate debt when you go in because you're getting paid for the risk of floating. So that was the dynamic 2018. Bridge loans were a no-no. Today, bridge loans are the way to go. Fannie and Freddie have loan caps of, I think, what is it, 80 billion each for the year, and that's 10 billion down from what they're normally doing. And so they're being far less aggressive, and and the steepness of the yield curve has returned to the market. We've got short rates at around 0, and then we've seen the 10-year Treasury run like crazy up to, I don't know where it's at today, 1.5, 1.6. So we finally have a steep yield curve again. So you actually benefit from floating on a short-term index. So bridge loans, you're seeing a lot more of it, which is less common in the syndication world, because we've all been talking about long-term cash flow, and it's this long-term conservative fixed rate debt, permanent financing, and that's done very well, and it's a really good selling point to investors. But today, like I said, a lot of people are going for the bridge loan because it's cheaper and it can be a better product. So we're kind of now battling the risk. A lot of people don't understand the increased risk associated with bridge loans. And so while they are today, I can show you in a second here, the actual cost savings of a bridge loan. Even if the interest rate's higher, you're getting more leverage. And so on a weighted average cost of capital basis, bridge loans can be much cheaper today. But so that background ties in nicely with stress testing, because I'd love for people to put in the chat where they think the largest source of risk in a multifamily deal is. Is it vacancy going up? Is it rents going down? Is it your manager quitting on you? Is it, COVID? To me, it's debt. It's always about how much debt you're putting on the property and what the terms are and all that good stuff. Because you can buy a Class A deal in a perfect location, but if you finance it at 95% LTV, to me, that's a very high risk deal. Whereas if you buy a bad deal, but you buy it all cash, I would say, well, that's probably a lower risk deal of actually incurring a permanent loss of capital. So anyway, that's a long preamble, but basically what I want to start with is jumping over to the sensitivities tab and showing you, this is kind of my stress test and sensitivities workshop. And so these tables here are very popular, these sensitivity tables. And so I highly recommend that you familiarize yourself with them and how they work, and go ahead and build your own. I'm seeing these become more popular actually as well with pitch decks and investors. There's a new trend of, I guess, compliance. And so people aren't wanting to just push an IRR number down people's throats and say, this deal's an 18% IRR, right? They're leaning towards maybe, well, let's give you a range and let's do these sensitivity analyses and whatnot. And I think it's kind of a win-win. Sponsors are essentially held less accountable to their numbers. If I tell you, well, the deal's a 1% to a 38% return. And then investors can look at the deal and kind of make a decision for themselves. So I'm seeing that as a trend, right or wrong. So I think it's important to understand these tables as an investor or a sponsor. But my favorite stress test is this refi exit test, which you may have heard me talk about before because I love talking about it and I think it's really interesting. And my lender friends know this very well because this is a lender's big test. If you're wondering why some deals get 2 years of IO and other deals get 5 years of IO, it's because of the exit test. Fannie Mae and Freddie Mac have a standardized stress test that they run, basically where at the end of the loan term, they look at where the outstanding debt is in relation to what new debt would look like on a refi. And, basically you might need more years of amortization to pay down your loan in order to be able to refi out in a stress test scenario where they're growing expenses faster than they're growing rents and whatnot. So this is very similar, but for us, we're not a lender, so we're less concerned about years of IO and exiting on a 10-year loan. We're very concerned about bridge loans. Like I mentioned before, back in 2018, everyone thought bridge loans were very risky because you would mature in a recession. Now we're in a recession and everyone's putting on bridge loans, and no one's really concerned about the fact that their loan matures in 3 years. Also, this is a trick question, but how do we reconcile the fact that everyone's underwriting is on a 5-year term, and everyone is used to seeing 5-year underwritings, 5-year hold periods? Bridge loans are typically at most 3 years with extensions. Like Cody put in the chat, he got a recent quote for a 3+1+1 deal. And so what that is you have an initial bridge loan term of 3 years. And then if you want a 1-year extension, you can pay a half a point or a point on the outstanding loan balance to go ahead and get another year's worth. So the thing is if you have a 3-year maturity on your bridge, but everyone's used to underwriting and looking at 5-year deals, what do? There's a mismatch there. And unfortunately, I think the not so elegant solution that people have been employing is simply ignoring that and just underwriting a 5-year deal with their 3-year bridge loan. And they say that it's a 5-year loan because they've got the +1+1, and they don't factor in the cost of the extension. So I can't say that's totally wrong, because at the end of the day, unless you have a really high rent growth number, the longer you hold something, the lower the returns are. As an example, here we have on a 3-year hold, 20.8, that's our base case. 4 years, it goes down about 100 basis points and then goes down another 50 basis points. So you can see the longer we hold, the returns go down. So when you underwrite this way in this kind of weird, impossible scenario, it's not that you're being too aggressive and overstating returns, because actually you're showing returns that are lower, unless, like I said, unless your rent growth is ticked up a notch. If you have rent growth, I think the math is just simply in excess of your annual expense increase. So if I just tick down property tax increase, so now we've got 3 on 2, 3% rent growth, 2% expense growth. Now if you look at that trend, why aren't I updating? Automatic. Okay. So it still goes down, actually. 29, 27, 26, down to 22. But sometimes, I don't know how to get the numbers just right, but sometimes when you have rent growth, you actually see the scenario that the returns get larger over time. So it just depends on the deal, which is always why it's good to look at it. So, but that's one thing that I found interesting in today's market. In my opinion, the best solution is to underwrite a 3-year hold, but I don't think everybody agrees with me, because when we present a 3-year hold, some people, push back on it and say, a 3-year hold, it doesn't look as familiar. What I wanted to also mention is that in the institutional world, or quasi more sophisticated institutional world, 3-year holds are more normal, and bridge loans are more normal. And that's even going back to 2018. I remember it was very dichotomous. I was speaking to like syndicators and passive investors, and they all thought bridge loans were the devil. But then I was talking to institutional investors, and they said, we won't do a deal unless it's on a bridge loan. And I can't remember exactly their argument for that, but I found that to be very interesting. In the chat, Michael's asking, are banks asking for COVID reserves on a bridge loan? I don't think so. Most of the bridge loan quotes that we're getting, there is not a COVID reserve. So I think that's becoming more true across the board. And when you say bank, I'm assuming you're not necessarily just referring to actual like banks, but you're talking about debt funds and just true bridge lenders. Okay, so the refi exit test, I kind of got away from it, but the idea is the biggest risk that we have here is maturity risk. Like I mentioned, the loan matures and you're in a recession, or the loan matures and your property is still not stabilized and you've got high vacancy and low property value. That is a problem. And the reason why it's a problem is because of leverage. Bridge loans are higher leverage than permanent debt because your lender is typically coming in with not just 80% loan to value, which is often more than your typical loan at 75% loan to value, but they're also loaning on cost as well. So if you have, like for example, here we have a $10.75 million purchase plus $1 million CapEx budget, they'll actually lend to you 80% on that sum. And they'll even sometimes be willing to lump in your closing costs. So if you have another $300,000 of closing costs, they'll just lump that into that sum as well and then lend 80% on that. And you can even get 85% loan to cost, which most people would consider that a stretch senior loan. And then the other thing is, other times you see they'll do 80% of purchase price plus 100% of your cost, which can be very nice as well. So bridge loans are great because you're getting a ton of leverage if that's what you want and if that's what the deal supports. But the issue with that is you're essentially leveraging the deal more than what it could afford or would qualify for on a permanent loan basis, because bridge loans aren't constrained to a debt service requirement on a current income basis, right? A bridge lender is like an equity investor because your bridge lender is buying into your business plan of what the deal will look like in the future after you implement your business plan. Whereas a permanent lender simply looks at the in-place numbers and says, I can lend to you X because the in-place numbers are Y. So that's the major difference. But the risk is you're not getting to the end result that you and your bridge lender are banking on. And so I just want to start showing that. So we're going in with this 80% loan to cost bridge loan, which amounts to $9.4 million. And what we're assuming here is we're running a 36-month test. So we're going to say that in 36 months, our loan matures and we're going to have to refi out of it. And so if you're not familiar, when you acquire something and you're looking for agency debt, you can typically get up to 80% LTV. Now on a refi, it's actually up to 75%. That's your typical agency guidelines. So that already brings you down, right? Going from 80% loan to cost now down to 75% loan to value, that can be a huge difference. So like this deal, for example, we're buying it for 10.75, we're putting $1 million into it. So our cost basis is 12 million, roughly speaking. And in this scenario, through our value add and everything, which again, this is just an arbitrary example, we're actually building the property value to 14.5. So we've created some real value. We put 12 in and now we've got 14.5 million of value. And so a 75% loan on that would be 10.8. And we're in business. We'd actually be able to roughly cash out 1.5 million back to the partnership. So this deal is a $3 million total equity check. So being able to cash out 1.5 million, getting back 50% of your equity is fantastic. So that's your base case scenario, and that's wonderful. But let's see how susceptible this deal is to shocks. So our first shock is operational shock, and the operational shock is simply just stressing revenue. And so we can do a 10% shock, a 5% shock, whatever is appropriate. And you might want to lean on historical measures if you can get your hands on them or something like that. But understand that revenue is in a way a levered metric because your expenses roughly stay the same. So if your expenses are 50% of your revenue and revenue goes down 10%, you're going to see a 20% decline, roughly speaking, in your NOI, which is how we value property. So again, if your revenue goes down 10%, that results in a 21% dip from your base case NOI to your shocked NOI, which brings the valuation down all the way back down to 11.3 million. So it's a very harsh shock. And I think it is slightly overstated because in the real world, an investor, if there was some reason why your revenue is down 10%, an investor wouldn't simply just put a cap rate on your in-place revenue and say that's my offer. Buyers look at the future, right? All of us here are likely value add investors, and so we're able to see upside and be willing to pay for that implied upside. So I think it is slightly overstated, but again, these are just good guidelines. So you can see here the problem is that if we're going to get a 75% loan on our new shocked value, it's actually almost $1 million below our in-place debt. And so what that would mean is simply a capital call. You would have to make a capital call, and your investors would have to fund the difference between the in-place loan and the new loan, or you would have to sell. You would sell the property at 11.3, you take a loss, right? It would be, I don't know, something of $1 million loss, but you would be able to pay your lender back. And that's what the lender wants. That's what they care most about. But obviously we don't want to take a permanent loss. So we're fine maybe getting suboptimal financing if we're in a recession and the sky is falling, but we can still refi and keep the deal alive. That's incredible. That's a great outcome. So that's why we look at the refi exit test. We're not so concerned about, can we sell for a profit in a recession? No, it's can we stay alive? Can we avoid maturity risk and getting our bridge loan hung and being forced to sell at an inopportune time? And so you can see that's how that works. The next one is the capital markets shock. And this is a scenario in which your performance at the property level stays exactly the same. 831. So your NOI is doing fine, but what happens is the capital markets are in disarray. So interest rates are up, cap rates are higher. So maybe this is like an inflationary environment or something like that, or just an environment where investors become bearish, and so the demand for investment product goes down. So here we have, instead of, let's say, the refi being valued at a 6 cap, it's at a 6.3 cap or something like that. And so instead of being 14.5 million, the property's value is 13.1. And also on the debt side, so so cap rates are driven by, many things, but really demand flows of capital, right? If there's lots of money chasing deals, cap rates will go down, all that good stuff. So that's the cap rate side. But then on the debt side, if lenders are scared or lenders don't want to lend, they're not going to extend to 75% leverage on a refi. Maybe they'll only do 70. And we actually experienced this firsthand in Houston, because when COVID hit, Houston went on the X list for Fannie Mae and Freddie Mac, and they did not like that market, oil and all that stuff. So we were only able to get 70% LTV refis. So it's very real reality. And so here, by knocking down your leverage by 5% and having a slightly higher cap rate, your value's down, and you're not able to actually get a new loan that meets the existing loan's value. So Daryl's asking, essentially, what are the capital markets? The capital markets are investors, lenders, everybody who's doing stuff with money. So it's not just interest rates, but it has to do with everything to do with money. So do investors want to buy, or do they not want to buy? And that kind of drives cap rates. And then interest rates are driven by, the 10-year treasury and all sorts of stuff. So that's the capital markets. And then finally, to wrap it up, we've got the both shock. And for so long, I've wanted to change the name to both shock, but I don't know why it hasn't made it in there. But the both shock is where both things happen. And this is truly a brutal, brutal stress test, which very few deals make it through. And I wouldn't say that, a deal is a bad deal if it doesn't make it. But essentially what you have here is revenue goes down like it does in the operational shock, and the capital markets are bearish like they are in the capital market scenario. And you can see, it's just a joke. It's just brutal what happens to you. Your value gets crushed, and then your new loan is 7.2. So you've got a $2 million capital call. But you could look at this and you could say, all right, truly, I think that's a very, very bad scenario, doomsday scenario. And you would say, my downside is I'm going to have to make a $2 million capital call. and to keep the deal alive. And I would say, you should understand that, and you should, if you can pull it off, I would say that'd be the ideal thing. But obviously getting money from investors when they see the sky is falling is very difficult. That's why we all pre-fund our deals with CapEx and reserves and whatnot. But yeah, that's the idea. I think if you can get, obviously you don't want these red numbers, you want it to be in excess. And so you might think, well, how do I find deals that pass these tests, or what do I do? And I think number one, you could kind of tweak the test to be more applicable to your deal specifically. The other thing too is I don't think anyone really is going to do this because it's hard to turn down cheap money, but instead of taking 80% leverage, you could do 75. And that's an easy way to pass these tests because you're just starting at a lower loan level. And so to pass the test, it's a lower bar. I mean, you say we still fail, then we pass, and then we of course fail. So, we obviously don't want to take on less leverage. That's no fun, but that is one way to help with this risk. The other risk is to extend your term. Like a 1-year bridge loan, I would say, is twice as risky as a 3-year bridge loan. And while the extensions may not be very attractive, you have to pay fees to extend that 3 + 1 + 1. Knowing that you have 5 years of total term is nice. I would also say that if you're in trouble, depending on who your bridge lender is, they may not want the property. I'd say most lenders probably don't want the deal. And so especially if it's underperforming, they're not going to say, yeah, give me the keys, I'll take over this headache. So if you do have a loan that matures and you don't have any built-in extensions, depending on the lender, it is not terribly unlikely that you'd be able to negotiate a deal where you keep on plugging away with the loan and keep paying interest, and hopefully they don't bully you around too much. But that is a vulnerable position to be in. But if that's all you have to do, or your only option, then of course you work with it. But that is that's the world of bridge loans. I mean, there are bridge loans out there that exist, or ways to finance a deal to mimic a bridge loan, but at a longer term. Like if the deal is stabilized, for example, one way that you could recreate a bridge loan, and can't remember when this was working well, but there was a time. See, it's always good to keep up with what's going on in the capital markets. Where interest rates, where are the flows of money, and who's lending most competitively. Because there was a period of time where if the deal was stabilized and would qualify for Freddie Mac floating rate debt, what you could do is you could essentially build your own bridge loan. You'd put Freddie floater on there plus a preferred equity piece on top, and you'd get to the same leverage point or even higher leverage point than a bridge loan, but you could have a 10-year term. And, if you just look at it, if we extend our term to 10 years, we pass all the tests because time allows us to grow rents and pay down our debt, all this good stuff. So that's one solution there. Today, the Freddie floater plus pref would still be a reasonable option. Definitely more expensive, but what you're paying for is that optionality. And again, that additional leverage coming from the pref, that's typically friendlier debt, right? Pref isn't going to foreclose on you and have all these, hard pay requirements or ideally. So it's, it's not true debt. So that could be a great option if you are, not looking for the full risk of a bridge. So yeah, I think that's a good stopping point. I don't know how I'm doing on time, but I appreciate everyone listening to that, and hopefully it made some sense and was valuable. I'm happy to dive into anything else or anything. So whatever we have time for, I'm up for it.
When you were talking about pref just now, were you referring to pref equity, or were you referring to more of like a pref debt?
Well, yeah, pref equity and pref debt are the same to me. But yeah, so I was referring to preferred equity, which, if people aren't familiar, is a form of supplemental leverage similar to mezzanine debt. And to some people, mezzanine debt and preferred equity is interchangeable as well. So it's not preferred return. as some people might misunderstand it.
Got it. And real quick, one more thing. I don't know if you want to mention your book, but I read your book several months ago and I was just a huge fan. It's an amazing book. I strongly recommend it for other folks that are looking to dive sort of into the modeling aspect in particular of multifamily.
I appreciate that. That's awesome. Yeah, I recommend everyone check out the book. It does a great job taking all my thoughts that are at any given time scattered and just, right there all for you to digest. So it's yeah, it's great.
Hey, Rob, we were talking a little bit about in the breakout session, but you were doing some pref equity. What does that market look like? I think most of the people here, are not doing really big syndications. So you were kind of targeting a lot of the people here on the call that syndicate deals. What does that market look like now for pref equity? You're not doing it. There's kind of a limited set of people that was kind of in that space. What does that look like right now?
Yeah. So what attracted us to the preferred equity space as a whole was the risk-adjusted return. We underwrite a lot of deals and we see the prospective returns to be quite thin. And, by being preferred equity, you're taking a more defensive position by sitting lower in the capital stack, directly after the senior lender. And so we were attracted to that. And then on a micro basis, or zooming in to the strategy, we noticed as potential preferred equity borrowers, we noticed that every preferred equity provider that we spoke with, their minimum preferred equity check was, 4 million, 5 million, 10 million. And we thought, wow, I mean, if the preferred equity piece is, let's just say 10% of the total capitalization of the deal, and these guys' minimums are 5 million, that means they're targeting $50 million deals and up. And that's crazy. And so we realized that there was a huge opportunity for the lower middle market space of really $25 million deals and below to come in with pref, because there's just no competition there. And and of course, nothing is just that simple. And we after being in that business and making small balance preferred equity loans, we realized why nobody's in the business. It's a huge headache. It's a ton of work. I mean, as we all know here, right? A single family house is the same amount of work as a 100-unit multifamily. So it's the same idea with debt, whether you're a bridge lender or a pref lender. $1 million pref piece is just as much work as a $10 million pref piece. So we get it. We get why it is. So, you got to put in more work to get but the returns are better because, you have no competition. So you could name your price in that space. So it's fascinating. And, the other issue again is preferred equity providers are often themselves private equity or backed by private equity. And, these types of groups have large funds and they need to put lots of money out of the door, and they can't do that with $1 million deals. So that's another reason why. So we've had good success with the preferred equity. It's definitely a lot of fun. I love thinking about it. It's a different way of thinking about deals. It's thinking more like a lender, but it's more creative. You get to structure the deal more creatively, and there's more levers to pull. When we're doing a syndication, it's like the only thing you can negotiate with the seller is the price. And then you structure, a syndication joint venture model, whatever it is, you maybe negotiate on the pref, on your promote, and on fees. And that's about it. But with preferred equity, it's a dance. You can maybe charge more interest, or maybe you can provide more leverage, or maybe you can, accrue more leverage versus pay on a monthly basis. Maybe you can prepay some of the income requirement. So yeah, it just gets more creative and it's more interesting. So that's my story there.
Thanks, Rob. But it sounds like that market for kind of the smaller pref equity is still pretty tight. There aren't a lot of options out there for smaller syndicators.
Yeah, I'm trying to think of anyone who does it, because I've seen some people come in Yeah, I know there's a couple, but yeah, it's surprising that, look, a lot of us do deals that are $20 million, and that size of deal can almost virtually not get preferred equity.
Mm-hmm.
So yeah, it's interesting.
Thanks, Rob. Does anyone else have questions for Rob and about stress testing or just in general? It's a wealth of knowledge here.
Yeah, Rob, this is great. Really enjoyed this, and this is very helpful for me. But I'm just curious, what would I be looking at this as the hold period for the investment would be whatever you decide as the manager of the investment. Basically, you're targeting 3 years, but it could swing a little bit.
Yeah. So as it relates to the exit test as a stress test, you would use the maturity date or the term of the loan to determine when to stress test it, right? Because you have a 120-month long loan or 10-year loan, there's really no reason to stress test it in year 3 because your loan's not due. So it doesn't matter. So if you have a 24-month bridge loan, you'd want to check out what's happening in month 24. And in my opinion, well, this is tricky because I would say, the 5-year underwriting is a standard, and I think it is a standard for a reason. It's long enough. It's not too long. 10-year hold period can kind of scare investors, but when it comes to bridge loans, my opinion is that your hold period should match your term. So 3-year bridge loan, 3-year hold period. And now you may have all the intention in the world to refi the bridge loan after 2 years and then hold for another 5. And so your actual hold period is 7 years. But for actual underwriting, I feel that it's more appropriate to do 3 years. Also, people hate looking at refis and underwritings. I feel like it's like the quickest way to get trashed, which, it itself is not a bad way to go. You could absolutely underwrite a deal with a refi, but people just assume that you're being aggressive because typically that's what it is, and that's what it does. Is it a refi, as you can understand, brings more cash flow sooner in the deal, and with the IRR, time value of money, if you're going to bring a lot of cash, into year 2 of that analysis, it's going to just boost the returns.
Great. Any other questions, guys?
Questions, but I feel like they're so basic.
Go for it, Aaron.
So
I'm sure others have the same questions.
Yes.
Okay, so like that is when it says valuation under NOI, like how do y'all come up with that essentially? Is that like what the market would pay for it? What is that? Is that the appraisal?
So that's driven by cap rates. So what we do is we say, and let me hold on. So here's the formula, super basic formula, right? We're just grabbing the NOI for that period.
Oh, divided by the loan amount. Is that
divided
right?
by the actually by the cap rate. So, and that's actually the refi cap rate, but it doesn't matter. So point is, we decide what cap rate we think is appropriate for the deal. And, for this deal, we're saying 6% cap rate. So what that means is that a new buyer would come in and value our deal at a 6 cap. So whatever our NOI is, they'll pay, a 6 cap. So if our NOI is 100,000, you can divide it by a 6 cap, and then they're willing to pay 1.66 million for the deal. And so that's the math as to how you derive that valuation. Okay. So here we have this NOI, and then we do that cap rate, and then there's your value.
Okay. So you're just switching the equation around. That makes sense.
Exactly right. Yep. That's my favorite version of that equation, right? The equation being value equals NOI. Wait, no, I'm sorry. Cap rate equals NOI divided by value, right? That's how you classically learn to understand cap rate. But, the one that actually people think about and use is this one. This is how like we actually in practice use it.
Okay. And loan to cost versus loan to value. I've asked this before and can you just explain that really quick? Loan to cost, is that the sales price?
So what we have is, so loan to value is most typically also loan to purchase price. And then loan to cost, the cost equals, I kind of explained this earlier on, the cost, it can be the total cost of the project. So in this, the way that I calculate cost is simply your purchase price plus your CapEx.
Okay.
So a lender will lend on your cost because theoretically, I mean, just to think very straightforward, let's just say you're going to put $1 million into the deal. You wouldn't invest $1 million into the deal unless you are actually going to create more than $1 million of value for the deal.
Mm-hmm.
Right? That makes sense. But let's just assume that by investing $1 million, all you do is you add $1 million of value to the property, right? That's a very conservative assumption. And that's what a lender is in a way kind of saying. They're saying your value up front is your purchase price plus your CapEx because they assume you're going to put the CapEx into the deal and they'll loan to you based on that.
Okay. So your loan to value is always going to be higher than your loan to cost.
That's exactly right.
Okay.
Yeah. If you have, I mean, even if your CapEx budget is just $1, like, even if your CapEx budget's $100, I mean, it might not show up in the formula, but your loan to cost is bigger, right? So if I make it 100,000, just a small difference, it's, loan to value higher, loan to cost lower.
Okay. Did you make this yourself?
Yep.
Wow. Sweet. Well, I appreciate it, man. Thank you.
Absolutely.
Could I ask a quick question?
Of course.
Yep.
All right. So you said earlier that if you do your underwriting, including a refi, you're going to get trashed. Is that you're going to get trashed by the investors? You're going to get trashed by the bank, or the?
Yeah.
I wasn't quite clear on what you meant by that.
Good question. I typically don't use such casual language. So yeah, investors are taught to repel that type of underwriting. Like if you're just like a fresh, brand new investor into the world, like the only things you know are that people get aggressive with their exit caps and their rent growth, and that refis are bad. Like that's the three things that you know. And so people automatically assume that you're baking in you're being aggressive and trying to sell the deal by having a refi in there.
I see. But aren't investors typically interested in getting their equity back as soon as possible so they can reinvest it in something else? So I'm fairly new to this, obviously, by the questions that I'm asking here, but I've been looking at a few opportunities as a limited partner, and I like the idea of a refi because I'm getting my money back sooner while still participating in the upside of the deal.
Yeah, it's a great point, and I completely agree with you. I think especially for investors, a refi can be a great execution. And I would say most investors agree with you. There are some investors that say, no, I don't want to have reinvestment risk, or I invested the money for a reason. I want it to earn a return. But yeah, like I said before, it's not that they don't want it to happen. Same thing with underwriting on a 5-year hold. Most investors would prefer to actually exit the deal in 3 years and achieve a higher IRR, but they prefer to see no refi and a longer hold period because it generally means it's indicative of more conservative underwriting. And the other thing that a refi does is it introduces additional assumption, the necessity to make additional assumptions in your underwriting. And obviously with every additional assumption we make, the more likely we are to be wrong. So that's why when I, built this spreadsheet, it's by far not the most complicated, but if you could see, this is my inputs tab. This is not that many inputs. I wanted to make how few of inputs can I have and still remain robust. And so it's, not having a refi. I mean, yeah, sure. We've got the refi right here, but we don't use it very often.
Thank you.
Rob, I think part of it too is like if you're comparing a deal as an LP that's not refi and you look at the cash on cash is inflated. So kind of comparing a refi deal versus a non-refi deal, you just have to be careful. Just juices up the returns a little bit.
Yeah, very good point. And it like you said, apples to apples. It basically eliminates the ability. I mean, trust me, we learned the hard way. We had a deal that our business plan was, look, this is a renovated asset. It's in good shape. It's just being poorly managed. We're going to lease it up in 6 months, and we have to buy it with a bridge loan because it's 80% occupied. You can't get perm debt. So we're going to buy it with a bridge loan, and we're going to refi super fast. And that was in our underwriting. And, it made it more complex to explain. The underwriting got pushback. And something that you don't fully realize is if I can kind of show you like a 10-year hold with, let's say, a refi that occurs in 24 months. So what happens is, maybe this is a bad example, but what happens is your equity multiple goes way down because you cashed out a lot of your equity. And now that equity is effectively, from the deal's perspective, is sitting on the sidelines and it's not generating a return. And so, I mean, a 3x in 10 years is still pretty good, but I was trying to show that.
I'll take it.
Yeah, exactly. But if I don't have a refi, so it was 3.11. If I don't have a refi, it's 3.31. So you see, you trade equity multiple, typically for higher IRR when you refi. And then, of course, like you said, you inflate cash on cash because, your cash flow is now denominated by a lower number. So yeah, that's a good point. And so that's kind of the issue with deals, is we all want to compare apples to apples. And even though I like the 3-year hold for bridge loans, I think it's harder for investors because they say, well, this deal's a 3-year hold, this deal's a 5-year hold. How can I really compare the two? And it's a fair point.
Okay. Any other questions?
Yeah, Rob, when there is a refi cash out, do you include that amount as part of your cash on cash return? It's not really cash on cash return of the property, right? It's a different event.
That's exactly right.
So do you even include that in when you show your cash on cash return, the refi proceeds?
So I'll explain. And I actually have a client that drives me nuts with all these requests, but not you. I'm saying like I build models for him and help him, advise him on deals and stuff. But so I'll show you how a refi works. So here you can see, just on the summary page, you can see investor puts in $1 million, and then here's their cash flow. But then at the end of year 2, so at the beginning of year 3, they get their refi proceeds, which is, call it 38% of their capital, right? It's a great win. You could see the way that that's treated here is we've got this row, proceeds from sale. And so actually $1 million comes out of the deal as cash out proceeds. But you see that it's not a cash flow item. It doesn't flow through the P&L and hit as a free cash flow item. It's a balance sheet item, and it goes as a proceeds of refi. And what it does is it should, and it does, reduce your capital account. So you can see we originally invested $3 million, but the proceeds was $1 million. And so now we've only got $2 million remaining invested in the deal for the next 10 years. So we actually offset our capital account, and cash on cash does change, not because we are adding this $1 million to the cash flow, but because now we're taking this $300,000 of free cash flow and we're dividing it by $2 million to generate this cash on cash return, rather than taking, let's say, $390 and dividing it by $3 million and getting 13%. So that is how you do it. When I mentioned someone driving me crazy, it's because some investors want to see what the cash flow is on their original capital, right? They don't want to they don't want to be in effect fooled by the refi. So what they want to see, and this is totally fair, but what you would do is you would say, all right, fine, it's 15% cash on cash on my remaining, oh geez, remaining cash on cash on my remaining equity, but on my original equity of 3 million, the cash flow is, I did this just not good, but like this, right? So on my original investment, I'm getting 10% of my money, but on my remaining investment, I'm getting 15%. And we could go like this and lock it. Oops. So yeah, hopefully that answers your question.
Yeah, I got it. So you're reducing your initial investment by the refi cash out. Yeah. I haven't seen that way, done it that way. So this is more thorough.
Yeah. No, this helps kind of normalize it against the deal that's not a refi, right?
Yeah.
Basically. It's nice. Any other questions, guys? Okay.
Rob, real quick, can you give what is the argument of not holding a property? I mean, like, I'll see properties, like on Yardi, it'll list like the purchase price, and people paid like, 23 grand, back 8 years ago, and now it's worth like over 100 grand a unit. I mean, what if you sold it 3 years later? I mean, I'd be pissed off,
Yeah.
Or I mean, I guess, maybe, times have changed, with what people are asking for selling price. So, I mean, I don't know.
Well, yeah, there's a lot at play, and it obviously has to do with your strategy. And I think people can point to historical appreciation and point back and say, oh, like for example, oh, well, my parents bought their house in 91 for 200,000 and today it's worth 3 million. So see, and it's like, well, I mean, maybe those numbers make sense, but first of all, we need to go back in time and actually run the numbers on it and say, okay, what is the actual IRR in that deal? And don't forget to factor in your parents' maintenance costs and all that good stuff. But, so I think people can get like, they can think of like a long-term appreciation as sexy. And it is, because it's the Charlie Munger, Warren Buffett method. You just sit and do nothing and you make your returns. But in my opinion, especially in the business that we're in, which is actively managing value-add real estate, especially as a sponsor, your best bet is to sell as soon as you're stabilized, because we often aren't buying in amazing locations because those deals just have very low prospective returns, and we're seeking to take on more risk. And so once you've generated the bulk of your value, you most likely want to get out. And you could get out through a refi, you could get out through a sale, but that's just my opinion. I think there are compelling reasons to hold. And from a sponsor's perspective, right, as the manager, there's two big things. One is monetizing your promote. If you created a ton of value, you're not getting rich off your acquisition fee or your management fees. You're getting rich off your promote, which is your performance compensation. So if you hit a home run, right, you're going to get 30% of the profits there. And that could be, even on a $10 million deal, it could be $1 million. So that's going to be at the top of a sponsor's mind. And even if it's a fantastic area, that sponsor's going to sell because they want that $1 million. So that's one, and I'd say that's the most powerful. Number two is management fees. And, on the one hand, you've got the promote, but on the other hand, you can't build $1 billion of assets under management and collect a substantial fee stream on that assets under management if you sell every deal. So it's as a manager, it's balancing those two things.
Thank you.
Yeah, no problem. And that's a really good topic. And I spent a lot of time talking about those types of discussions because it's an emotional discussion too. It's not just numbers. it's, you know, I'm attracted to the property, or I like managing it, or I haven't squeezed out all the juice out of it yet. And so there's a lot to that question. And someone is asking a great question in the chat as well about like basically doing an opportunity cost analysis of, well, if I refi out my equity or I sell and get my money back, can I reinvest it into something that's going to get me a higher return? And so that would be determined by your return on equity. You would analyze what equity you have in the deal, and you'd see, well, what is that return generating? And if I can generate a higher return on equity elsewhere, then it would benefit to sell and go and do that.
Okay.
Yeah, that always seems to be, you know, as your equity goes up, and say, what could I be doing with that equity? And can I be doubling my return? So say you've got 100,000 in a $500,000 condo. Okay. So obviously you're renting it, you're getting a return on that investment. Could I take that 100,000 and go buy myself another condo? Now I've got 2 growing. See, and then the 3, and then the 4, and then 10, and then trade up to a multiplex, et cetera, et cetera. So that seems like you could have a faster growth in your wealth package if you were to refi out and keep plugging that in. But then of course there's a trade-off, because, you know, now the original equity is not gaining the original property is not gaining as much ROI, right? I think that's what you just said, but I'm just trying to restate it so it fits in here.
Yeah, that's exactly right. And it's a funny tug of war, because I'll argue with people or explain or have conversations where I'll say, you should sell. But they'll say, oh yeah, but what if I can push the rents $50 more and the cash flow is going to be an extra $10,000 a month? Then I'd want to keep it, because that extra 10 grand a month is awesome. I'd say, but if you're able to generate that extra 10 grand a month, then your equity in the property just went up, and then you could sell and actually get that money out of the deal as well. So it's all connected. So if you're able to raise rents, then your equity just went up. And so you can't just say, oh no, I like this deal because of the cash flow, because by having cash flow, there's an implication that you have equity there.
Yeah, and then forgetting about what could be done with the money. So, you know, $50 a month, you know, on a large deal, of course, that creates 10 grand. But if you're, you know, you can put that into something else, be creating another $500 a month.
Exactly.
For the same equity.
So Daryl shot me a message here to mention my upcoming course. So I've been working for a while on launching an underwriting course, which is includes, you know, the bulk of it is a pre-recorded multi-module course going through every step of my underwriting process, you know, with sharing my screen like we did here, but obviously a lot more focused and less rambling. And then in addition to that, with the course, it's a ongoing experience where we kind of work together to continue to improve our understanding and make new content, always adding new content to the course. So, you know, because people come to me, you know, I don't even have the course out yet, but people are always reaching out to me and saying, how do I do this in the model? Or if I'm thinking about it this way, how do I implement this? And so finally, I've created a way that I can add value to more people and just deliver a better service, if you will. So no landing page, no sales offer yet, unfortunately. So I can't, you know, direct you anywhere, but if that sounds of interest, I greatly appreciate you. And, you know, let's just keep in touch. And, you know, the best way to get in touch with me is on our website, lscre.com.
Great. Yeah, Rob, put that in the chat for everybody.
Oops, sent that to Daryl only.
Got a nice subscribe button there, right? About half a page down. Smart.
Yep, that's right. Yep.
This has been great, Rob. Adding tons of value. I think. Yeah, I know you were a little bit tired from kind of what was been going on. So really appreciate you giving us a lot of time here, kind of going over and asking a lot of questions. we'll record this for everybody as long as Rob is okay with us kind of posting it and making sure that we put it on the website. This has been great. And for anybody that wants to stick around a little bit longer, we could do more networking sessions. I know some people are on the East Coast, it's getting late. If you want, grab a beer, grab a whiskey, and sit back and we all can kind of network. But just gonna quickly flash our contact information for our team here.
Want me to stop sharing my screen?
Yeah.
Yeah, just
Yeah, go ahead.
put things, V cards and line report.
Yeah, and if people want to share their contact information, put it in the chat. And, if you click the 3 dots, you can save the chat and get everyone's information in there. And this is our information, Line Real Estate Partners, based here in Dallas. We do have a deal coming up potentially. So, if you're interested in kind of talking about it, let us know. And thanks for joining, everybody. Thanks, Rob, for giving us your time here. Added tons of value. Really, really, really great session, diving into details. I think we all learned a lot. So thank you.
Yeah, thanks everyone for being on and give me some good energy tonight.